legit. Anything you want.
Celente predicted the stock and crypto crash. Here's what he says is next. The top trends forecaster in the world, Gerald Celente, who predicted the stock and crypto crash, discusses what's next. Economic 9/11, stocks and cryptos crashing. Real estate and retail next? Gerald Celente, and September 19, 2 days before U.S. equity markets hit new highs, we alerted Ren's Journal subscribers to prepare for an economic 9/11s despite Wall Street optimism following the U.S. midterm elections that equities would spike. Markets are tanking as we had forecast. What's next? The first shots of the economic 9/11s we forecast have been fired. Even cryptocurrencies are crashing. But again, Ren's Journal subscribers were forewarned and forearmed. How low will it go and what's next? As far back as August, our crypto trends expert, Jonathan Cho, had forecast that the decline will continue and that Bitcoin's bottom is in the $1,000 range or slightly below. What's occurring now is the beginning of the end, likely not just for Bitcoin but for unbacked cryptocurrencies, as they likely never gain the heights they did in 2017, Cho said. While cryptocurrencies are highly speculative and unrelated to economic fundamentals, so too are stock and real estate markets, which have been artificially inflated by the cheap money craze that has boosted them to soaring heights. Danger ahead. There is a dangerous economic road ahead. From the International Monetary Fund to the biggest hedge funds in the world, they are flashing warning signs that the worst is yet to come. Signs and signals of the economic 9/11s we had forecast that they just now are beginning to recognize. The only possible reversal of the current market decline is if the Federal Reserve reverses its aggressive schedule of interest rate hikes. It was their monetary methadone that juiced equities and real estate markets to their artificial highs following the panic of 2008, and only another money drug fix will keep them from temporarily crashing before they OD. Celente, prepare, global market shock is coming. Today the top trends forecaster in the world, Gerald Celente, warned that global market shock is coming. A global market shock. Prepare. Gerald Celente, his signals are clear. The warning shots have been fired. Equity markets across the globe have lost trillions as investors increasingly worry about the two-punch strike of slowing economic growth and rising interest rates. World economic climate deteriorates further. IFO Institute. Eurobond yields rise after IMF debt default warning volatility. Global growth is slowing, and markets need to pay attention. IMF Japan's economy contracted in the last quarter. Eurozone economy seen cooling. Wall Street Journal looming maturity of Chinese property debt triggers default fear. Financial Times. The U.S. Federal Reserve appears on track to raise rates a fourth time this year in December. As we have long noted, with some $250 trillion in global debt, much of it dollar-based, as the dollar grows stronger and global currencies get weaker, the cost burden of servicing the debt grows heavier, and as interest rate rise and currencies grow weaker, so too is economic growth slowing in both emerging market and developed nations. In China, the world's second-largest economy, gross domestic product growth has slowed to panic of 2008 levels, and the Shanghai Composite Index is down some 30%, while Asia's main equity gauge has also sunk into bear territory, with its stocks losing some $5 trillion this year. Across European markets, the FTSE All-World Index ended October down over 7%, its worst performance since the peak of the 2012 Eurozone crisis. In the U.S., the Nasdaq slumped 9% in October, its biggest drop since the panic of 2008. And the S&P 500 lost 7%, its worst month since September 2011. Despite initial market optimism following the America's midterm elections, on Monday the Dow plunged some 600 points and lost another 100 points on Tuesday. While U.S. equities are rebounding today on news of lower-than-expected inflation rates, which would suggest a less aggressive interest rate increase policy by the Federal Reserve, since the decrease was marginal, we forecast it will not affect Fed policy, and downward market pressure on equities and real estate will continue. Warning signs among the leading indicators of a global economic slowdown are diving oil prices, which are on their longest losing streak on record. Brent crude has dropped more than $20 to $66 from its 2018 high, declining 25% this year. In part, the slide is due to President Trump's softening of the oil embargo he threatened against Iran. The other, more relevant factor is supply and demand. There is more supply than demand because economic growth is slowing worldwide. Trend forecast: while oil prices are trending lower, should tensions in the Middle East escalate and oil spikes above $100 a barrel, it will shock both equities and economies worldwide. Moreover, with signs the Fed will continue to raise rates, not only will higher rates push currencies lower, since oil is dollar-based it will cost more to purchase oil, and as evidence, the interest rate increases will also push equities and real estate prices lower across the globe. We still maintain gold prices are near its bottom at $1,200 and remains a safe haven asset.